Hello, this is Domenico with Easynomics, and this is a final video on calculations in the context of a paper 3 with excise taxes, calculating changes to consumer, producer surplus, welfare loss, government revenue, and in this video, PED and PES, price elasticity of demand, price elasticity of supply. This will be part of a series of different playlists on the channel. One playlist is dedicated to paper 2, paper 3 type calculations. That will be linked in the video notes below. There was the first video in this little series was breaking down the indirect tax and really having a deeper understanding of the model to understand this more simplified model that we use on our paper exams. We then went on to use the real-world example of cigarette taxes in the state of New York and applying the non-price determinant of substitutes, how a higher price for cigarettes in one state, like New York, can cause consumers to seek cheaper alternatives out of state, like in the state of New Hampshire, where it's cheaper. So let's go into this final set of questions. So there's two other videos where we looked at questions A and B, and then another video that we looked at questions C and D, and then this final video, we're going to tackle questions E and F, price elasticity of demand, price elasticity of supply. This is our workings from that previous video. We were looking at question C, calculating the welfare loss, assuming that the welfare loss highlights the allocatively efficient amount of cigarettes that's desired, and then the government intervenes and takes us away from that. Of course, that's not the case. Governments intervene to reduce the demerit good, but it was just a way to practice identifying the welfare loss on an indirect tax. And then we also calculated the excise tax revenue collected. So question E, let's get into this last set of questions. Using figure 1, calculate the price elasticity of demand. We want to make that calculation when price paid by consumers increases from 10 to 13. Okay, so we have an initial price of 10 and a final price of 13. We're going from the initial, let's see if I can find a color that you can really see here. I'll use green. The initial of 10 going to the final price by the consumer of 13. So PED, what is the formula? You need to know that. You don't get a formula sheet for your paper 3 May exams or November exams. It's the percent change in the quantity of demand divided by the percent change in price. And we want to remember that percent change is a formula of the final variable, final, minus the initial, divided by the initial, times 100. So that's why I'm marking on my exam the initial and the final. And here we have the initial of 250 million packs going down to final 220 million packs. So pause the video and go ahead and calculate PED, and then we'll check your work with mine. Pause the video now. Okay, so let's take a look. We're going from this point here to this point. We're measuring the elasticity of demand between these 2 points. Let's say from point A to point B. So PED is equal to the percent change in quantity. So that would be a final quantity, final of 220. I'll leave out the millions for now just to keep it simple. 220 minus 250, final minus initial, divided by initial, 250 times 100. And all of that will be divided by the change in price. And the change in price is final being $13, 13 minus the initial of 10 divided by the initial of 10 multiplied by 100. All right, and that will give me the PED value. So if you work that out, 220 minus 250 divided by 250 times 100, that equals negative 12%. Over, that's the change in the quantity. Quantity demand has decreased by 12% over a 30% increase in price. So that equals negative 0.4. So PED, in this case, is inelastic. The PED is less than 1. We notice that the change in price is greater than the change in the quantity of demand. So it gives us a very steep demand curve due to its addictive quality. So here I have the final answer. The PED is 0.4. We look at the absolute value. It's less than 1. That means that for every 1% increase in price, there is a 0.4% decrease in the quantity of demand. That's what the PED value tells us. Okay, let's move on to the last question, question F. Let's calculate the PES value. PES, when the price received by producers falls from 10 to 8. So we're going from 10, that's the initial, to final of $8. What's the formula for PES? You should know this. PES, price elasticity supply, equals the percent change in the quantity of supply divided by the percent change in price. Okay, so pause the video and try calculating that as we go from point A to point D. Or sorry, let's change that to C. From A to C. Okay, pause the video now. All right, so let's do this. All right, so this would equal the percent change in quantity. It can be the same as the percent change in quantity for the demand curve. We're both going from this quantity of 250 to 220. So it's essentially the same. So 220 minus 250, I can leave out the millions, divided by 250, final minus initial divided by initial, times 100. And then all of that divided by the change in price. That will be the final price received by the producer being 8 minus the initial of 10 divided by the initial times 100. Okay, and we do that, and it works out to negative 12%. Right, we see that's the same here, because the quantity is the same, divided by the change in the price received by the producer. Producer's price fell by 20%. Negative 12 divided by negative 20, that works out to 0.6. So PES is inelastic in this case. And that would be our final answer. PES equals 0.6, meaning that for every 1%, let's say, increase in price, the quantity of supply would increase by 0.6, or if the price fell by 1%, the quantity of supply would decrease by 0.6%. And that's it. So that was a practice question. We're given a model. We've calculated the changes to consumer and producer surplus using the trapezium formula. We've identified and calculated the welfare loss and the government tax revenue generated. And we've also used the model to calculate PED and PES. And that's it. If you have any questions, you can comment those questions below. And don't forget to subscribe and to like. Thank you so much.